Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today, Denise Chisholm joins us on the program for a deep dive into the factors shaping today's markets. She discusses the recent U.S. vice presidential political debate, as well as the influence of taxes and commodities on the market. Denise talks about the vice presidential debate and describes it as neutral and lacking new information. She emphasizes that political leadership, while a major talking point, often has minimal long-term impact on the markets. She notes that historically markets perform better with divided governments and tends to discount political changes before they happen, reducing volatility. Denise also touches on geopolitical risks and the potential for an oil price shock. She says that while Middle East tensions can drive oil prices up, a true risk to the economy would only emerge if prices hit $160 per barrel. At those points, the impact on corporations and consumers would be significant enough to pose recession risks. Shifting to gold, Denise points out that while gold prices are inversely related to interest rates, gold equities don't always outperform when gold rises. Instead, she sees better opportunities in sectors like financials, real estate, and industrials, especially if those sectors are poised for recovery. This podcast was recorded on October 3rd, 2024.
Hi, Denise. Great to see you today.
Hi, Pamela. It's great to be here.
I thought the debate was sort of pleasurable watching. What did you think?
It was a normal debate, harking back a decade or longer. I mean, I thought that was one of the more interesting parts about the debate was its normalcy and its civil discourse. But we didn't hear a lot in terms of substance either, any substantive differences versus the other debates or the open policies that we kind of know as investors currently.
And so in terms of something being material and pointing to market moving things like specific policies, industrial, tariff policies, everything. Yeah, it was a bit of a neutral. Is that fair?
It was a bit of a neutral. It didn't give us any more additional information, which for me, I tend to sit on the other side of this issue as much as people want to look at the differences between the platforms at providing substantive differences that would impact your portfolio. I have to say that I'm just largely skeptical of that for a variety of reasons. One of which is, first order effect is that whoever the person is or personnel is not necessarily policy. There is a bleed, you see, historically speaking, from the president-elect to what the president can get done on whether or not Congress is divided. And one of the reasons why you see in the data that divided Congress, regardless of who is the president, usually provides better returns for the stock market over time. Not by a large percentage in terms of probabilities, but significant enough that you say no change or sort of stymied change is actually usually the better outcome for the market. But there's real interesting data when you think of policies that should be very empirically effective on equity market returns that just are not. So let's take taxes as one. I think that is definitely a potentially different outcome with the different candidacies, and certainly we can integrate it in terms of our debt equation in the US. But when you look back at history, and we have the marginal tax rates going back to the 1930s, and you say, okay, the 10 or 12 times we've seen marginal tax rates at the highest tax bracket increase, has this been empirically a bad thing for the equity market? Not only will you find that it's not usually statistically a bad thing for equity market, but on average, the equity market has higher than average returns the year and even the year before taxes go up. Look, which is not to say that taxes don't necessarily matter. It's just that there are other moving variables that impact consumption, that impact GDP growth, like maybe job growth, like corporate profitability, that matter a lot more. So as much as we want to zero in on the impact of what policy might mean, I think history shows some really clear red flags of creating this all else equal effect. If taxes go up, spending goes down, therefore the stock market is at risk. And what you see is that it oftentimes, and most oftentimes, doesn't exactly happen in that linear fashion. So you have to focus on the other variables that are more influential. And one of those variables that I'd focus on is our profit recovery, that we are still in potentially the beginning stages of what could be a multiple year durable earnings growth recovery.
This brings smiles to equity investors' faces, exactly what you just said. And we'll go further into that profit story in just a second. I just want to round out the debate. So to the extent then, with everything you're saying, how much can we look through the election? How much do you wait till it's over and have a relief rally? How much do you just sort of hold on? I mean, speak to that looking through or waiting on it.
I would just never recommend any kind of market timing from a short-term perspective. If you have your own strategy as an investor and have taken years to develop it, I still have not with studying all the data. I think it's really complicated in terms of if you feel as an investor that you are at risk of getting a bad news event, right? Let's just consider the election a potential bad news event. I think choosing whether or not to buy or sell ahead of that bad news event is just very fraught, because more often than not, the market can climb that wall of worry, or the market has discounted that bad news event in advance. I mean, again, we don't have to go very far back to figure out a time when the market did exactly that, and that was the banking crisis in 2023. Ironically, the year following that, or even just the months following that, financials was one of the best sectors in the market. So as much as you think that there is going to be this absolute determinant event on market outcomes, again, I do think that history cautions you on that. What I will tell you that I'm watching is always my uncertainty data, because as an equity market investor, you have to know that the more uncertain the outcome, the more likely the market is to advance after whatever the outcome is, meaning that there's certainty on the other side of whatever the news flow is, and the market usually rallies around that. So I will tell you, I will point you to the NFIB small business uncertainty measure that's at all-time highs. The last time we saw it be this uncertain was 2020. The time before that was in the election around 2016. And what happened in those events, the higher the level of the uncertainty, the more the pain trade is higher, which is to say that I think that this is one mathematic representation of the potential wall of worry the market may climb despite the potentially divisive or volatile election that is surrounding us at this time.
Okay, fascinating how all of this works. Back to the recovery in profits ultimately, and to the energy sector, because this is what we were going to focus in on. The energy sector, one would think, has been massively impacted over the course of the last couple of weeks because of Middle East tensions, and it sort of brings forward that question of short-term, long-term. We're putting the sensitivities and the tragedies there aside to just look at the price of oil and what happens ultimately with these short-term, long-term disruptions. What do we do with the price?
Yeah, no, I mean, for the overall market, we'll take the overall market first, and then crude oil as a secondary effect, because there have been times in the past with Middle East embargoes and other such things that if there is significant disruption in the Middle East, that has led to a price spike. But when you think about just general geopolitical risk, as much as you think that this would be something that, again, very clearly matters historically to the markets, you really don't have to go back, again, too far in history to realize that it's not the significant influence that you might think it is as an investor. And there's reasons, or at least theories around that. I mean, one, again, going back to the history, I mean, I think it surprises most investors that the returns that we saw during World War II, from even 1937 all the way to 1945, averaged 6%. In the S&P 500.
Wow.
So again, that is the World War. So I think that again cautions you as to just how influential geopolitical risk actually is on market returns. And that's around the fact that, one, the market can actually discount some of this in advance, goes back to that wall of worry, goes back to those uncertainty measures, like, are you sure the market hasn't already been worried about the geopolitical risk that is definitely different the coming decade than it was the last decade, meaning that the more you hear investors talk about that as a differentiating factor, the more likely it's priced in.
Right.
So that's number one to be concerned about in terms of the influence. Data point number two is that as much as it is very much all war is a human tragedy, it is not a significant determinant of GDP growth or earnings growth, at least historically speaking. It doesn't mean that there couldn't be some correlation depending on the circumstances, but historically there hasn't really been a persistent correlation. And those two things are more likely than not the drivers of equity market returns. And then the third thing is very, very theoretical and has never really exactly been proven in the data, but I do find fascinating, which is to say, the more uncertain the environment, the less willing corporations are to spend. And given that reticence, boom times are less likely to prevail, which means that bust times are less likely to prevail, which is to say, in a very odd fashion, it could be that it evens out the cycle. Any kind of fear has that potential over the long term to even out cycles because there's less likely risk of boom times. And that is the biggest risk to equity market returns.
It moderates sort of overconfidence and over risk taking, obviously, and therefore just smooths out the ride. That's absolutely fascinating. You've got to model an instrument on that somehow or something. Thank you. Okay, let's go directly to energy. So what would it take, again, back to the oil price, to create the shock that would sort of shock and create a recession and so on? It's pretty far out, right?
No, that's a great segue because I talked about the market, but I didn't talk about crude oil specifically. So obviously we have seen geopolitical risk in the Middle East, historically speaking, cause quite a price increase in crude oil. And the difference this cycle is the starting point, I would say, on the impact either on crude oil to individual people, so the percent of overall income that you spend on energy, and the same can be said for corporations in terms of the ability for crude oil as an input to corporate profits. And that is what's different. So when you look back historically to the times that geopolitical risk has created an upside in energy prices that has been able to be a shock to the US consumer or the US economy, it usually has to be around 1.5 to 2.5% of disposable income. Right. That's the trigger spot where that significantly impacts demand. And once demand declines, that starts the economic cycle. So there can be that translation mechanism from geopolitical risk to crude oil to the shock that tips us into a recession. The question is, what level of crude oil would get us to that shock that we have seen in history? And remember, it's relative. It's not an absolute price. It's the ratio of price to income. So income has grown, and substantially so, on a nominal basis this cycle, specifically since 2020. So that proportionality has really created a very, very high hurdle rate. So when you think about what price of crude oil would create that shock, you're really now talking of something like 160 to 190. Wow. As the price that you would need to have, at least to fulfill the historic tendencies to potentially create a shock for the US economy. So we are a fair way off there. So you're talking about a double in crude oil. I don't think that something like $100 crude would be enough, at least using the lens of history, to create the problems that we've seen in the past.
So we can afford it. We may not want to, but we
Correct.
can afford it.
You never want to.
You never want to. Yeah. But it's possible to absorb up until a higher area there. Okay, so just take us back through the history again, going through the relative sort of cycle of energy of oil and where it's been. There's been a big cycle of CapEx actually that had to do with where we saw energy rise and then no more of that, give it all back to investors. And then that seems to kind of be over. So where are we in the cycle, I guess, for the price?
Yeah, so let's talk about the CapEx cycle because that was a significant driver of certainly the relative performance in the stocks. And what we saw in 2016, 17, 18 was really CapEx relative to sales was at all-time highs. We had never seen CapEx be so high historically in the energy sector overall. And that was a concern for investors. They are spending so much to get oil out of the ground. They aren't disciplined in their CapEx. This over-reliance on CapEx was actually leading to very substantial increases in production, which was going to sort of cap price increases. And oh, by the way, energy companies weren't giving that money back to shareholders. So entered the pandemic, and we saw one of the largest demand shocks that we had seen since, I think, the 70s. It was one of the first times that crude oil demand actually contracted, right, which is actually a buy signal for the sector overall. But we saw a contraction in demand. And on that contraction in demand, we saw the biggest reduction in CapEx ever seen in the history of energy companies. At the same time, where geopolitical risk actually created a really big spike in the price of crude, you put those two things together, energy companies coming out of the pandemic were the most profitable they have ever been historically in the data set that I have going back to 1960, right? So very profitable time for energy companies. Now, CapEx has stayed disciplined relative to sales, but it's also starting to inflect higher. It's not nearly as high now as it was in 2016, 2017, 2018. We're still in the bottom quartile. The companies are still solid fundamentally. They're still generating a ton of free cash flow, but that second derivative has moved, and it's actually moved by a lot. At the same time, where despite that CapEx is very efficient and rig count is down, that oil production in the United States is hitting all-time highs again. These are incredibly productive assets that, despite the fact that the decline rates are very high for shales, we are still seeing more efficiencies and more production. This, historically speaking, is a very poor setup for energy from a relative performance perspective going forward. You have a change in the second derivative, meaning as much as they're generating a lot of free cash flow, they're going to generate less free cash flow going forward. At the same time, you've got a supply problem, right? When you look at the data, and I'll send you all to my LinkedIn, if you want to see a great chart, you can look at crude, US crude production going back to 1921. So really, from my data is usually from 1962, because that's when good fundamental data starts. And you'll find that in the vast majority of that time, 65% of those years were when US energy production, crude oil production, was declining.
So I was just going to say, this is the US production. This is not the global story. This is US.
Correct. That's just the US production, which is rare, right? I mean, we have become the swing producer.
Yeah.
Despite the fact that, government policy changed as it relates to the energy sector, again, production, despite that, just hit all-time highs. Again, go look at the chart. I mean, it's really interesting. So much so that I should have log scaled it. I put it on a linear scale. And the hockey stick forward in terms of US production from 2013, when the shales became productive assets, is really shocking when you look at it in history. So the supply is different this time. And you're seeing that difference this time be combined with the change in the second derivative of free cash flows, at the same time where that peak profitability that we saw is still renormalizing. So these are headwinds that the energy sector has been, look, I'm not going to say completely unable, because 10 to 15% odds of outperformance over a rolling 12-month basis is not zero, but it's very unlikely that energy becomes the recovery play that many investors actually think of, especially when we talk about China and the stimulus in China and a potential US soft landing, and now the Federal Reserve cutting interest rates. I think that there's a lot still gravitating towards, oh, well, if that's all true and we have a recovery that's global, I would like to buy energy to be part of that recovery. And I think that the starting points matter much more than a recovery play, at least historically speaking.
So aren't we are told sometimes that we are at a starting point of needing a ton of energy for data centers, and there's discussions of whether nuclear will fill that bill or fit that bill, and then there's discussions about whether solar has a role to play. There's still things to be worked out there. If they can't work out some of those, doesn't that just mean more demand for oil for data centers?
It does. I think that, when you think about energy production overall, even despite, we were calling for a potential secular demand decline in fossil fuels 4 years ago, and that has not proven to be the case. I think you're exactly right in terms of the energy demand just keeps growing cycle to cycle, and that will involve all energy production. So if it's, this is not an either or proposition, I think, anymore when you look at global demand. It's not, should it be solar or wind or fossil fuels or natural gas or nuclear? I think that it's a cohesive use of all of those to meet global energy demand. So look, if you are a bear on energy and it's because of a secular decline story, I'm not sure that that's likely to play out. Even just when you look historically, like I said, energy demand, it's very rare that it declines, historically speaking. I mean, even during the 70s when we had an energy crisis, and even 2020's demand decline was very brief in nature. So as economies, and this is, including first world to third world, improve their living standards, that requires consistent energy demand. So even AI aside, just global economic growth, not contractionary growth, does lead to increases in energy demand, which will likely call all forms of energy production.
And yet it's still not tipped for the outperformance, as you say. We'll get into the sectors that are in just a second. There's some great questions coming in, so I'll just put these to you if you don't mind. So thoughts on, these are going into things that aren't related, but still important to the overall economy, of course. Thoughts on what the US ports shutdown plus Middle East escalation could mean for the price of oil. You've hit on a number of those there. Is there anything just with the ports that you might add to that on the short term? Yeah.
Yeah, so no, that's a great question. Any kind of short-term disruption risk reminds me of a government shutdown. So when you assess those things, again, going back to the short term, the market has an odd, interesting way to price that in very efficiently and very effectively. One-time events that aren't durable in terms of consistent outcomes to earnings usually don't impact the market overall. And look, we'll see. It doesn't mean that there's 0% chance. If there was a port strike that shut down the ports for many, many months, that might be a different outcome, at least in the short term. But usually what you see is that even like government shutdowns that actually lasted multiple months had very little market impact because of that one-time impact that leads to potentially pent-up demand that gets reprieved on the other side. So the market oddly looks through those things historically. Again, I can't tell you 100% of the time, but I'm always wary of making one-time risk factors that are potentially temporary as a core piece of your portfolio. Now, lastly, as it relates to the potential price side of the ledger, look, same thing. I mean, we've seen shipping costs go up over the last 12 months. We've seen, now this is a concern in terms of, price stickiness, in terms of all that. I still think the disinflationary measures are going to be more impactful to the deceleration of inflation rather than supply chain risks going forward.
Another question here. Can you talk about gold price fluctuation historically? So looking for some back data there.
Yes. So gold is different than crude oil. So crude oil certainly, well, I should say oil, that everybody tells me crude oil is redundant. So oil marches to its own drum. And then as much as gold and crude are correlated through the time, if you had to pick from a commodity perspective, they are very, very different. So what you do see, statistically speaking, is gold prices are inversely related to interest rates. So the more likely the Fed is to cut, the more gold prices are to go higher, the more likely gold prices are to go higher. And I will say one thing that Roy Justice, our global technical strategist, brings up all the time is that gold is the only commodity in a long-term uptrend. You don't see that in any other commodity that usually takes stair-step patterns over time. So gold is unique in and of itself. And again, as much as we want to put different things in terms of gold, what does it relate to? Do you want to buy gold because the US is indebted? Again, I can't prove those things statistically speaking, but gold and interest rates are an interesting corollary. So from a commodity commodity perspective, if you had to pick a positive risk reward in commodities, it would certainly be gold over any of the other commodities. That said, I will send a cautionary note in terms of gold equities, because the upside in gold prices doesn't always relate to outperformance in gold equities. So, which is not to say that gold equities are a short or anything like that. But I do think, for me, when I look at the market risk reward, I think that there is still significant overall upside in the market overall, which means that the market might actually be up more than gold prices. And if that is the case, gold equities may be a laggard, and the better opportunities might be in financials and real estate and in those very economically sensitive sectors like home building that's also rate sensitive, or equal weighted industrials that are more levered to a recovery in ISM and manufacturing. So this is not to say that gold is problematic, but just always think about the difference, or the bleed, I would say, in terms of alpha potential from the commodity all the way to the equities.
Fantastic. Say more about what you were just talking about. I was going to ask you about, so what do you like? Consumer discretionary is something that you've been talking about for some time, also financials and industrials and real estate, but just a little bit more. This is the interest rate sensitive story.
Yeah, so I was just looking at the consumer discretionary data, which is intriguing. I think that that's going to be the topic of one of my next notes, certainly my next note internally. That for the first time, so the big problem on a cap weighted basis for consumer discretionary, I've been a bit of an equal weighted proponent. Neither have worked really over the last 12 months, and both have underperformed the market, sometimes in significant amounts. And from a cap weighted perspective, the headwind, or one of the headwinds, has been valuation. This is not true from an equal weighted perspective. That has not been the headwind. But from a cap weighted perspective, that has been a headwind. So the stocks were expensive on forward PE, on trailing PE, on price to book, and on price to sales. And you are starting to see that completely unwind. So price to book and price to sales are still elevated in terms of being top quartile expensive. But when you have profitability, meaning you have top quartile returns or top quartile operating margins, then it's never a problem for the stocks historically. This has been true in most of the sectors. And what you're finding is you're almost back to normalized valuations on forward and trailing PE. And interestingly enough, you are actually back to bottom quartile valuations on free cash flow. This is much the story that we see around technology, which is to say that they're modestly expensive on earnings, but then oddly cheap on free cash flow because they have not had to spend CapEx, especially relative to the rest of the parts of the market. So free cash flow generation has been substantial, and this is very true in consumer discretionary. So you are now cheap on a measure that has mattered. All the while, as much as we're worried about the US consumer and have been concerned about the US consumer, earnings growth on both a cap weighted and equal weighted basis for the consumer discretionary sector has been very powerful. We're actually growing at top quartile, and in some cases, top decile levels relative to the rest of the market. So earnings growth has not been the problem. Valuation has been the problem. To the extent that rate cuts coincide with at least a stabilization in valuations, and potentially, now I'm talking about sort of being bottom decile in terms of this relative price to free cash flow for consumer discretionary on a cap weighted basis, that really skews your risk reward for the entire sector higher. So it's not just the interest rate sensitive sectors that have intrigued me for quite some time, like home builders, but this is now a broadening out story where we weren't really looking at sort of consumer discretionary while it got cheaper and cheaper and cheaper because earnings growth has been so solid, which I think surprises investors because they think that the consumer is, and it's true, they've been bifurcated. So there's many parts of the consumer that have been still depressed because of inflation and because of credit costs. But what you find is an overall sector earnings growth has been quite significant. So it's really growing into those valuations that maybe created the headwind of the past 3 years that will not be a headwind of the next 3 years.
I love that. And you landed that so beautifully. It's a delight to speak to you always. Denise Chisholm, thank you for joining us here today. Look forward to seeing you soon.
Great to be here.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.